regarding the Fed's semi-annual report to Congress on monetary policy and the state of the economy. It will come as no surprise to you, Chair Yellen, that improving economic growth is a key priority for Congress this year. 2016
on a slow but steady pace, some 70-plus months in a row, there finally is some wage growth. Yet there are concerns. Too many Americans who want full-time work still can't find it. Many workers have left the labor force. The gains have been not large enough and been uneven. Foreclosures and job losses hit African American and Latino communities particularly hard during the crisis. One study found that the average wealth of white families has grown 3 times faster than the rate for African American families, and 1.2 times the growth rate for Latino families over the last 3 decades. These rates, it will take hundreds of years for those families to match where white families are today. For affluent Americans, stock portfolios have recovered nicely since the crisis, but for most of Ohio and for most of our states, the story is very different. The state's job growth last year was the lowest since 2009. We actually went backwards 5 out of 12 months. In many places, 1 in 4 homeowners is still underwater. As you've heard me say, and as members of this committee have heard me say, in the zip code my wife and I live in Cleveland, in the first half of 2007, there were more foreclosures than any zip code in the United States of America. For Ohio manufacturers, the strong dollar continues to hurt exports. And there is uncertainty, much of it injected into the economy by this administration already and by the majority party. Can Americans continue to count on having health insurance? Will U.S. manufacturers and exporters have continued access to foreign markets? Will importers have to pay a 20% sales tax? Will immigrants to this country have access to jobs and to our universities? They don't even know what to expect tomorrow, let alone to do any kind of long-range planning. All of that our country and our economy is dependent upon. Americans elected the new president based on his promises to drain the swamp, to take on Wall Street and bring manufacturing jobs back to the industrial heartland. We're all concerned, though, when you look at some of the nominees confirmed, with virtually every Republican, virtually every time voting for amazingly ethically challenged nominees that would have stepped aside 8 years ago or 16 years ago with new presidents. We're all concerned about that. Instead of focusing on infrastructure and real job creation and tax cuts for the middle class and education and workforce development, we've seen the new administration target working Americans, furthering a billionaire special interest agenda, and threaten Wall Street reform based on the false promises that banks are not lending. False promises, some might call them lies. I think everyone in this dais can agree there are parts of Wall Street reform that could be improved and steps that can be taken to help small banks and credit unions. That's an ongoing process for both Congress and the regulators. I applaud the Fed decision, Madam Chair, its recent decision to remove banks below $250 billion in assets from part of its CCAR process. But many of my Republican colleagues are dead set on going beyond the reasonable, consensual, bipartisan adjustments and seeking to repeal reforms that are key to preventing the next devastating financial crisis. Working Americans lost trillions of dollars in their retirement savings after large Wall Street firms made risky bets with other people's money, either failed or were bailed out during the crisis. That's why Congress put in place higher capital requirements for large banks, mechanisms to identify and regulate risky non-bank companies, and tools to make sure financial firms can fail without bailouts funded by taxpayers. Recent statements by top officials in the White House indicate they are specifically targeting these important safeguards, even though these parts of the law were supported by both parties back less than a decade ago. Now the administration is putting Wall Street bankers in charge. Steve Mnuchin, again, every single Republican voted for him, was confirmed by the Senate last night. They are going after the rules that their former employers don't like. They are trying to take away the financial regulators' freedom to make difficult decisions that will keep our financial system stable. These priorities are wrong. American voters agree. 80% in one poll. That's Republicans and Democrats and independents. 80% agree we need tough rules and stronger, not weaker penalties for Wall Street. I want to take a moment to recognize one person in particular who has been one of the chief architects of the stronger rules that have been put in place over the past several years to rein in Wall Street misbehavior and excess. Last week, Governor Torrillo announced he's leaving the Board of Governors. I want to thank Governor Torrillo for his service to our nation over the last 8 years. He's one of a handful of dedicated public servants who have made our financial system safer for a generation to come. I also want to recognize Scott Alvarez, who is in his 36th year at the Federal Reserve. He is seated right behind, if he would put his hand up for a moment, Mr. Alvarez. He's in his 36th year at the Fed. He's been general counsel of the Fed, I believe, for over a decade. Thank you for your service, Mr. Alvarez. Madam Chair, I look forward to hearing more from you about the current state of the economy, the importance, especially the importance of strong rules to guard against economic calamity. I know you're not going to be there forever, although I wish you were. And the importance of the strong rules that you have put in place and you will continue to put in place over the next dozen months or so, more than that, and what Congress can do to help the economy create jobs and make it easier for all Americans, and I underscore all Americans, to accumulate wealth, to buy a home, to pay for college, and to have a decent, honorable, dignified retirement. Madam Chair, it's a pleasure to see you.
Thank you, Senator Brown. And again, Madam Chair, we appreciate you being here. We look forward to your opening statement at this point, and then we will engage in some important discussion. You may proceed.
Thank you. Chairman Crapo, Ranking Member Brown, and other members of the committee, I'm pleased to present the Federal Reserve's semi-annual monetary policy report to the Congress. In my remarks today, I will briefly discuss the current economic situation and outlook before turning to monetary policy. Since my appearance before this committee last June, the economy has continued to make progress toward our dual mandate objectives of maximum employment and price stability. In the labor market, job gains averaged 190,000 per month over the second half of 2016, and the number of jobs rose an additional 227,000 in January. Those gains bring the total increase in employment since its trough in early 2010 to nearly 16 million. In addition, the unemployment rate, which stood at 4.8% in January, is more than 5 percentage points lower than where it stood at its peak in 2010 and is now in line with the median of the Federal Open Market Committee participants' estimates of its longer-run normal level. A broader measure of labor underutilization, which includes those marginally attached to the labor force and people who are working part-time but would like full-time jobs, has also continued to improve over the past year. In addition, the pace of wage growth has picked up relative to its pace of a few years ago, a further indication that the job market is tightening. Importantly, improvements in the labor market in recent years have been widespread, with large declines in the unemployment rates for all major demographic groups, including African Americans and Hispanics. Even so, it's discouraging that jobless rates for those minorities remain significantly higher than the rate for the nation overall. Ongoing gains in the labor market have been accompanied by a further moderate expansion in economic activity. U.S. real gross domestic product is estimated to have risen 1.9% last year, the same as in 2015. Consumer spending has continued to rise at a healthy pace, supported by steady income gains, increases in the value of households' financial assets and homes, favorable levels of consumer sentiment, and low interest rates. Last year's sales of automobiles and light trucks were the highest annual total on record. In contrast, business investment was relatively soft for much of last year, though it posted some larger gains toward the end of the year, in part reflecting an apparent end to the sharp decline in spending on drilling and mining structures. Moreover, business sentiment has noticeably improved in the past few months. In addition, weak foreign growth and the appreciation of the dollar over the past 2 years have restrained manufacturing output. Meanwhile, housing construction has continued to trend up at only a modest pace in recent quarters. And while the lean stock of homes for sale and ongoing labor market gains should provide some support to housing construction going forward, the recent increases in mortgage rates may impart some restraint. Inflation moved up over the past year, mainly because of the diminishing effects of the earlier declines in energy prices and import prices. Total consumer prices, as measured by the Personal Consumption Expenditure, or PCE price index, rose 1.6% in the 12 months ending in December, still below the FOMC's 2% objective, but up 1 percentage point from its pace in 2015. Core PCE inflation, which excludes the volatile energy and food prices, moved up to about 1.75%. My colleagues on the FOMC and I expect the economy to continue to expand at a moderate pace, with the job market strengthening somewhat further and inflation gradually rising to 2%. This judgment reflects our view that U.S. monetary policy remains accommodative and that the pace of global economic activity should pick up over time, supported by accommodative monetary policies abroad. Of course, our inflation outlook also depends importantly on our assessment that longer-run inflation expectations will remain reasonably well anchored. It is reassuring that while market-based measures of inflation compensation remain low, they have risen from the very low levels they reached during the latter part of 2015 and first half of 2016. Meanwhile, most survey measures of longer-term inflation expectations have changed little on balance in recent months. As always, considerable uncertainty attends the economic outlook. Among the sources of uncertainty are possible changes in U.S. fiscal and other policies, the future path of productivity growth, and developments abroad. Turning to monetary policy, the FOMC is committed to promoting maximum employment and price stability as mandated by Congress. Against the backdrop of headwinds weighing on the economy over the past year, including financial market stresses that emanated from developments abroad, the committee maintained an unchanged target for the federal funds rate for most of the year in order to support improvement in the labor market and an increase in inflation toward 2%. At its December meeting, the committee raised the target range for the federal funds rate by 1/4 percentage point to 1/2 to 3/4%. In doing so, the committee recognized the considerable progress the economy had made toward the FOMC's dual objectives. The committee judged that even after this increase in the federal funds rate target, monetary policy remains accommodative, thereby supporting some further strengthening in labor market conditions and a return to 2% inflation. At its meeting that concluded early this month, the committee left the target range for the federal funds rate unchanged, but reiterated that it expects the evolution of the economy to warrant further gradual increases in the federal funds rate to achieve and maintain its employment and inflation objectives. As I noted on previous occasions, waiting too long to remove accommodation would be unwise, potentially requiring the FOMC to eventually raise rates rapidly, which could risk disrupting financial markets and pushing the economy into recession. Incoming data suggests that labor market conditions continue to strengthen, and inflation is moving up to 2%, consistent with the committee's expectations. At our upcoming meetings, the committee will evaluate whether employment and inflation are continuing to evolve in line with these expectations, in which case a further adjustment of the federal funds rate would likely be appropriate. The committee's view that gradual increases in the federal funds rate will likely be appropriate reflects the expectation that the neutral federal funds rate, that is, the interest rate that is neither expansionary nor contractionary and that keeps the economy operating on an even keel, will rise somewhat over time. Current estimates of the neutral rate are well below pre-crisis levels, a phenomenon that may reflect slow productivity growth, subdued economic growth abroad, strong demand for safe longer-term assets, and other factors. The committee anticipates that the depressing effect of these factors will diminish somewhat over time, raising the neutral funds rate, albeit to levels that are still low by historical standards. That said, the economic outlook is uncertain, and monetary policy is not on a preset course. FOMC participants will adjust their assessments of the appropriate path for the federal funds rate in response to changes to the economic outlook and associated risks as informed by incoming data. Also, changes in fiscal policy or other economic policies could potentially affect the economic outlook. Of course, it is too early to know what policy changes will be put in place or how their economic effects will unfold. While it is not my intention to opine on specific tax or spending proposals, I would point to the importance of improving the pace of longer-run economic growth and raising American living standards with policies aimed at improving productivity. I would also hope that fiscal policy changes will be consistent with putting U.S. fiscal accounts on a sustainable trajectory. In any event, it is important to remember that fiscal policy is only one of the many factors that can influence the economic outlook and the appropriate course of monetary policy. Overall, the FOMC's monetary policy decisions will be directed to the attainment of its congressionally mandated objectives of maximum employment and price stability. Finally, the committee has continued its policy of reinvesting proceeds from maturing Treasury securities and principal payments from agency debt and mortgage-backed securities. This policy, by keeping the committee's holdings of longer-term securities at sizable levels, has helped maintain accommodative financial conditions. Thank you. I would be pleased to take your questions.
Thank you very much, Chair Yellen. And I want to get into that last issue you talked about with regard to the Fed's balance sheet. But before that, I've got two or three quick questions I just wanted to go through with you. First, Dodd-Frank established a new position at the Federal Reserve, the Vice Chairman of Supervision. President Obama has never yet designated anyone for this role, and instead, Fed Governor Dan Tarullo has acted as the de facto Vice Chairman for Supervision in various ways, including by chairing the Federal Reserve Board's Committee on Supervision and Regulation, overseeing the large institution Supervision Coordinating Committee, and representing the Fed at the Financial Stability Board and in Basel, among other functions. What role do you envision for the Fed Vice Chairman for Supervision having, and how do you envision working with this person when we get one nominated? And is it your expectation that a presidentially appointed federal vice chairman for supervision will have the responsibilities that Governor Tarullo currently has, including, and among other things, chairing the Committee on Supervision and Regulation and negotiating on behalf of the Federal Reserve in Basel?
Chairman Crapo, I think, as you know, the entire board has responsibility for approving new rules, but the vice chair would head our supervision and regulation committee and would coordinate our efforts in this area. He or she would also represent the board on international negotiations of financial regulatory standards, including representing the Fed in Basel. And beyond that, the new vice chair would fulfill any statutory obligations, such as providing semi-annual testimony to Congress on supervision. I look forward to working with that individual.
Thank you very much. Secondly, President Trump recently issued an executive order directing the Treasury Secretary to work with the member agencies of FSOC to review the extent to which existing laws and regulations promote certain core principles. First of all, do you agree that it's important to promote the core principles mentioned in this executive order? And do you plan to work with the Treasury Secretary and other members of FSOC to ensure that this review occurs?
I certainly do agree with the core principles. They enunciate very important goals for our financial system and for supervision and regulation of it. And I look forward to working with the Treasury Secretary and other members of FSOC to engage in this review.
Thank you very much. My third question before we get to the balance sheet is Fannie Mae and Freddie Mac were put into conservatorship in 2008 and continue to dominate the mortgage market. I'm not alone in calling for housing reform and considering it the most significant piece of unfinished business following the financial crisis. Do you believe that finding a durable, comprehensive legislative solution for the housing finance market is urgently needed, and are you willing to work with us to help achieve that?
Yes, I think it's very important that Congress continue to deal with the GSEs and figure out what the government's role in housing finance should look like going forward. The goal of bringing private capital back into the mortgage market, I think, is important, and I would hope that Congress would decide explicitly on what the government's role is, and if there are guarantees that they would be recognized and priced appropriately. And we look forward to continue working with you to help achieve these objectives.
Well, thank you. I just wanted to get your comments on those few issues before I go into this final question on the balance sheet. The Fed has said that it will not begin shrinking its balance sheet until normalization of the level of federal funds rates is well underway. Recently, some Reserve Bank presidents have suggested that it's time to consider beginning that process. What are the benefits of starting to let the balance sheet run off rather than relying solely on short-term rate hikes to tighten policy? And as short-term rates rise, is it problematic to have the large balance sheet continuing to put downward pressure on longer-term rates?
Well, Chairman Crapo, the Federal Reserve resorted to purchases of longer-term assets after the financial crisis at a time when the economy was very depressed, unemployment was very high, inflation running below our objectives, and extraordinary support was needed. But we would hope that that was a very unusual intervention and one that we would not frequently be relying on in the future. The FOMC has enunciated that its longer-run goal is to shrink our balance sheet to levels consistent with the efficient and effective implementation of monetary policy. And while our system evolves, and I can't put a number on that, I would anticipate a balance sheet that's substantially smaller than at the current time. We would like to, in addition, we would like our balance sheet to, again, be primarily Treasury securities, whereas, as you pointed out, we have substantial holdings of mortgage-backed securities. Now, to adjust financial conditions in order to influence economic developments in line with our dual mandate objectives, The committee would like, to the maximum extent possible, to rely on variations in our short-term overnight interest rate to accomplish that objective. It's our traditional tool. It's the one that we have the most confidence in, that markets best understand how we set it, and we have the greatest confidence in our ability to calibrate it relative to the needs of the economy. So we do not want to use fluctuations in our balance sheet policy as an active tool of monetary policy management. So what we would like to do is to find a time when we judge that our need to provide substantial accommodation to the economy in the coming years is minimal, when we have confidence that the economy is on a solid course and the federal funds rate has reached levels where we have some ability to address weakness by cutting it. And once we have that confidence, we will begin to allow maturing principal from our investments to gradually and in an orderly way, we will stop reinvestments or diminish them and allow our balance sheet to shrink in an orderly and predictable way. The committee has decided that it will not sell mortgage-backed securities, but as principal matures, we will begin to allow those assets to run off our balance sheet. So we do expect to be discussing in greater detail. We gave general guidance that we want to wait to start this process until the process of normalization is well underway, and the committee in the coming months will be discussing issues pertaining to reinvestment strategy to try to provide some further guidance.
Thank you very much. Senator Brown.
Thank you, Senator Crapo, Mr. Chairman. Madam Chair, you testified last year that the banking system was more safe, more resilient. Is that still true?
I believe so, yes. I mean, there is much more capital in the banking system. The quantity of high-quality capital, Tier 1 capital, has more than doubled since before the financial crisis. There's much more liquidity. I believe the financial system is much more resilient than it was.
Thank you. Now that we know that, and I think we already knew that, I appreciate your assertion and convincing arguments that you've made for some time. Some have remarked that banks are not lending now. Is that true?
Well, a recent survey by the National Federation of Independent Business, which is smaller businesses, indicated that only 4% of respondents were unable to get all of the loans that they needed, and the fraction of businesses ranking inadequate access to credit as their main problem stood at 2%, which is an extremely low number.
So just because people
lending has expanded overall by the banking system and also to small businesses, C&I lending.
Just because people in high places say it's true doesn't make it so. Are U.S. banks competing? Others have said that U.S. banks can't compete. Are U.S. banks competing relative to their international counterparts?
U.S. banks are generally considered quite strong relative to their counterparts. They built up capital quickly, partly as a result of our insistence that they do so following the financial crisis. And as I mentioned earlier, are very well capitalized, and their lending, their price-to-book ratios are substantially higher than the ratios of banks headquartered in other areas, and they're gaining market share, and they remain quite profitable.
So banks are safer and more resilient. Banks are lending. Banks are able to compete with their international counterparts. Consumers, some have said consumers are worse off since the crisis. Are consumers better protected today from abusive and deceptive and fraudulent practices than they were?
Well, certainly we're focused very much on protecting consumers in our implementation of strengthening the financial system. And of course, consumers were very seriously harmed by the financial crisis, but I think we've seen a significant recovery.
And the Fed is tailoring rules, as we've discussed personally and in this forum. The Fed is tailoring rules for communities and for community banks, regional banks, the largest banks, based upon factors including size and riskiness, correct?
Yes.
It seems to me that steps taken after the crisis with higher capital requirements, as you've said, with stress tests, with orderly liquidation authority, with the Consumer Financial Protection Bureau have made our economy stronger, our financial system more stable, our banks better capitalized, and our consumers better protected. I think that if the rules are removed, as one executive said during the crisis, if the music's playing, you've got to get up and dance. If the rules are removed, Wall Street will almost assuredly be right back to the risky and reckless behavior we experienced before you took this job, back before the crisis. A couple of other lines of questions, if I could, Madam Chair, Mr. Chairman. Recent executive action directs the Secretary of Treasury to chair the Financial Stability Oversight Council, FSOC, to review the rules and other activities of each member agency of FSOC, including the Fed, to determine if they're consistent with the certain core principles of the executive branch. I know the Fed and other agencies regularly review their work to make sure that the rules continue to enhance financial stability and promote safety and soundness and to protect consumers. To the extent that you provide any information or conclusions to Treasury or to FSOC about your agency's rules as part of this process, could you provide those materials to the Banking Committee?
So I don't yet have any clarity about what the process will involve, but
when you do,
we always try to work with our oversight committees to provide materials that are, relevant to your oversight of us.
Thank you.
We will strive to.
And we will count on that. Thank you. I have doubts about the executive order that requires federal agencies to eliminate 2 rules, in many cases 2 consumer protections for every new rule. I'm particularly troubled by what that means for financial regulators, a little like telling the highway department to take down 2 feet of guardrails for every foot it puts up. Is it clear that, a series of questions, and I'll put them together if you would answer, is it clear that financial regulators, including the Fed, are not covered by this rule? Does it make sense to remove 2 safety and soundness rules for every new safety and soundness protection? Does it make sense to remove 2 consumer protections for every new consumer protection? Will it make our system more stable and better protect consumers from bad actors?
So I believe that the independent agencies are not covered explicitly by the rules, but let me just say that considering regulatory burden and looking for ways in issuing rules and reviewing outstanding rules, constantly looking for ways to mitigate burden, I think is an important goal, and it's one that we will have strived and will strive to achieve, and it is a legitimate and important goal.
Understanding, of course, what some people call rules and regulatory overreach, others call consumer protection and environmental protection and worker protections. Chair Yellen, last question, Mr. Chairman. I want to follow up on an issue we've talked about, diversity in the Federal Reserve System. We see the least diverse president's cabinet that we've seen any time in the last 3 decades. The presidents of 2 of the most diverse Federal Reserve districts in the country, Richmond and Atlanta, have announced their retirement. Each bank has begun its search for the replacement. What is the Board of Governors doing to ensure that a diverse set of candidates is considered for these positions?
The board consults with the search committees that are charged with nominating individuals to serve as presidents of the reserve banks, and we consistently emphasize that diversity is an extremely important goal. We ensure that the search is inclusive, that robust efforts are made to identify diverse pools, and that the boards are focused on this important goal as they go about their searches.
And then the last connected question. Significant racial disparities in unemployment and wages persist everywhere, not, of course, just Mississippi, Louisiana, Maryland, South Carolina, places in both of these districts. What is the Fed doing? What is the Fed doing to ensure that these challenges are understood by the board of directors in these districts? What can be done by the Fed or others to address these issues?
Well, I think we are trying to address issues of high minority unemployment by adopting policies that result in a robust labor market and strong overall job conditions. Over the last year, for example, the unemployment rate of African Americans, I believe, has come down about a percentage point, moved substantially more than that for white Americans. So a strong labor market does improve the situation of vulnerable minorities, although it is, as I mentioned, disturbing that such large disparities continue to exist.
Thank you.
Senator Shelby.
Madam Chair, good to see you.
Thank you.
I want to pick up on the theme that Chairman Crapo got into a minute ago, dealing with the Vice Chairman of the Fed. We've been hoping that we did at one time hope that President Obama would nominate someone, but he didn't. But now, as I understand it, there are going to be 3 openings at the Fed. Trullo, this is coming April, whenever it is, he's resigned. 2 other openings that there. And then your tenure, you're appointed, till next February? Is that correct?
That's correct.
Do you intend to fulfill this last year of your appointment?
I do intend to complete my term as chair.
Sure. What will be the mechanics of how the Fed vice chairman will work? The chairman got into that some with the whole board. You mentioned that he would come before the committee to testify. He would represent people in the international deals, dealing with regulatory relief on regulatory affairs and so forth. You got anything else to add to that?
Well, importantly, he would chair our board committee on supervision and regulation, and that committee takes the lead on behalf of the full board in working with the Division of Supervision and Regulation to craft rulemakings that are then brought to the full board for a vote. The vice chair would head that committee and would have oversight in that role for our Division of Supervision and Regulation, and would also represent us in supervision, international supervision groups, such as the Basel Committee.
So if we have 3 new appointments to the Fed Board of Governors, that'll be 3 new people to deal with, and you'll have to deal with that as a chairman. Is that right?
Of course, we have diverse membership.
Sure.
Changes over time, and the role of the chair is to work constructively with all the governors to manage the matters that Congress has charged us with.
When you're getting in the area of monetary policy, inflation, deflation, so forth, price stability, what is the biggest challenges you're looking at all the data inside to see where inflation's rearing its head and so forth? Is it wages and salaries? Is that one of the big components? Is it energy is generally is a component there, and food's a component, but sometimes you don't count that, What is your biggest challenge in measuring, engaging, in configuring what inflation's doing or not doing?
So we look at many measures of inflation. Our objective, we recognize that food and energy are very important
volatile,
parts.
isn't it?
consumers spend a good share of their budgets on food and energy. We do not want to ignore movements in food and energy prices in measuring inflation. So in my testimony, I began by saying that an overall comprehensive measure of price increases that includes food and energy ran at 1.6% last year. There are many different measures. We've focused explicitly in saying that we have a 2% inflation goal on the measure we regard as the best measure we have of consumer prices, which is the Personal Consumption Expenditure Price Index. It's less well known than the CPI, but we think it's actually a more comprehensive measure. Now, food and energy prices are very volatile, and in looking forward over a number of years and trying to estimate where inflation is going, we often look at measures called core measures that remove food and energy prices. Wage developments, it's unclear that they have much direct effect on inflation, but generally what we've found is that in a situation where labor and product markets are tight, inflation tends to move up, and movements in wage growth gives us a sense of just how tight labor markets are.
In the area of regulations, last time you came before this committee that you alluded to, I believe it was back in June, I asked you the Federal Reserve's plans to tailor the CCAR process to provide much-needed relief to smaller regional banks. On January the 30th, the Federal Reserve issued its final CCAR rule, which tailored the process for institutions that have less than $250 billion in total consolidated assets and less than $75 billion of total non-bank assets. What is the significance of what you did there, and how will that help them?
I think that change will reduce burden substantially for a significant number of institutions. After engaging in a 5-year review of CCAR and our stress testing methodologies, we decided that the capital planning processes of those smaller institutions could be adequately reviewed and commented on through our normal supervisory processes, and that it was appropriate to exempt them from the qualitative portion of that capital review. But we still are subjecting them to our stress tests and asking that requiring that they conduct stress tests themselves. That is an important component of our supervision.
But as a regulator, you will continue to monitor that, and if it needs to be tailored, you'll do it, whatever it takes.
Yes, we believe very strongly in tailoring to make sure that our regulations fit the risk profiles of particular institutions, and especially for smaller institutions, we're very well aware of the burdens that they face and are looking for every way we can find to mitigate those burdens.
Thank you.
Senator Reid.
Well, thank you, Mr. Chairman, and thank you, Madam Chair, for your leadership. Some of my colleagues in the Congress have called on the Federal Reserve to use a formula, a very strict formula in setting interest rates. Many times they refer to the Taylor rule. Could you explain to us how this would affect particularly working Americans? Would it be good or bad, and how do we explain its ramifications to our constituents?
Well, right now, the Taylor rule would call for a short-term interest rate somewhere between 3.5% and 4%, which is obviously a much higher value of the federal funds rate than the FOMC has deemed appropriate given the needs of the economy. I believe we would have a much weaker economy if in the last number of years we had followed the dictates of that rule. unemployment would be substantially higher, the labor market would be weaker, and instead of inflation, which is running below 2%, and we want to see it move up to our 2% objective, I believe inflation would likely be lower than it is now.
So we'd see fewer jobs, higher mortgage interest rates, a weaker economy if we were essentially just automatically following a formula.
That's right. I recently, a few weeks ago, gave a speech at Stanford where I tried to explain why I thought it was appropriate to adjust the recommendations of rules like that to take into account, for example, the fact that not only the FOMC but most outside forecasters believe that the so-called neutral rate of interest has been unusually low in the aftermath of the crisis, and the Taylor rule would assume that it's at 2%. Current estimates would put that estimate closer to zero.
Thank you. There's another aspect I've been working on for years, and particularly incorporating some of the language in the Dodd-Frank bill, is ensuring that clearing platforms are used, but there is a risk because systemic failure would be significant. So can you give us an update on what you are doing, your colleague, to ensure that these central clearing platforms are adequately protected from a failure, i.e. the consumer is ultimately protected from failure?
Well, we strongly believe that well-regulated and well-managed financial market infrastructures, and that would include central counterparties, play a positive financial stability role. They can help stem the propagation of disturbances, and they reduce the volume of transactions among key financial institutions. And we think they play a financial stability role, but they can also be sources of risk to the financial system if they're not themselves well managed. Title VIII of Dodd-Frank created a structure in which the Federal Reserve, the CFTC, and the SEC have oversight responsibilities to make sure that these key infrastructures of our financial system are managing their own risks successfully. And we're cooperating with the other regulators in our examinations to make sure that appropriate risk management standards are in place.
Thank you. Final question in that. Cyber security is the issue on everyone's mind, and you recently have an advance notice proposed rulemaking which would require a board of directors to have adequate expertise. I've been involved in legislation that would apply not just to financial institutions but a publicly held company, because the cyber threat is not limited, it is ubiquitous. Could you just briefly, and very briefly, give us your sense of how important it is to get this cybersecurity expertise on board?
Well, I think cybersecurity is a major, major risk that financial firms face. I think they're very well aware of the risks, and my sense is that boards of directors generally appreciate the seriousness of cyber threats, but sometimes they don't have a comprehensive or enterprise-wide view of the institution's capabilities in this area. And so it is very important for boards to have appropriate expertise.
Thank you very much, Madam Chair. Thank you.
Senator Corker.
Thank you, Mr. Chairman. And Madam Chairman, thank you for your service and being here today. I, too, want to thank Mr. Tarullo. Didn't always agree with every decision he made, but we had vigorous debate, and I do think he was a committed public servant, and I want to thank him for his service, along with Mr. Alvarez. I know we were in the foxhole many, many times back in 2008, and again, I thank you for your service. Madam Chairman, I was interviewed earlier today, and people have always sort of hinged their futures on what you have to say, and I guess it's somewhat thankful now that it looks like you have a little bit of a partner. We knew at one time there probably were going to be no changes here, not being pejorative, it's just the environment we lived in. And yet now we look at potential tax reform, we look at potential changes to the health care policy, we look at things relative to infrastructure and all of that. As you see those possibilities occurring, is that affecting how you look at monetary policy decisions moving down the road? A stagnant situation before, just again because of the environment, a very changing possibility policy environment here. Is that something that's affecting your deliberations?
So we recognize that there may be significant economic policy changes and that those changes could affect the outlook. We're very well aware of that. And we don't yet have enough clarity on what changes will be put in place to really clearly factor those policy changes into the economic outlook. So we don't want to base current policy on speculation about what may come down the line. We will wait to gain greater clarity on policy changes and try
those
to
policy
assess.
changes, though, once you develop greater clarity on what you think is coming down the pike, could in fact affect monetary policy decisions.
Well, it's one of many factors that could affect monetary policy decisions. So I think the answer is yes, they could. Exactly how depends on the timing, size, composition.
And growth,
Many
I guess, would generate, growth could generate additional inflationary pressures, and so paying attention to that, and when that happens, it can happen fairly quickly, can it not?
Well, we will certainly pay attention to it. I think some policies may have supply-side impacts and raise productivity growth and sustainable growth. For
you mentioned something about sustainable trajectory. You're hoping the administration will develop policies that cause a sustainable trajectory relative to fiscal issues. Is there anything that you're seeing coming down the pike or being debated that has caused you to raise that issue? I agree with you, by the way, but is there something you're looking at that caused you to put a note in there? Is that just a standard line that would be in a report like this?
Well, I think we've known for many, many years that the U.S. fiscal trajectory is not sustainable, and the Congressional Budget Office's most recent forecasts show deficits increasing over the next 10-year period under their baseline, and the ratio of debt to GDP.
So nothing, it's just
rising.
the standard, is nothing that you're looking at coming out of the administration or Congress that's causing you to raise that alarm. It's more just the standard concern that many of us have, that we're really conducting ourselves in a totally inappropriate way as it relates to deficits. Nothing that's being discussed policy-wise right now.
Well, I mean, some of the policies that are being discussed, and in that context, they may also have impacts on economic growth and the economy's growth potential. So it's not a simple matter to evaluate, but I do think it's worth pointing out that fiscal sustainability has been a long-standing problem, and that the U.S. fiscal course, as our population ages and health care costs increase, is
very 100%. You gave a very fulsome answer to the balance sheet question, and I understand how the Fed funds rate is much more targetable and much more accurate. I guess what I haven't understood is just allowing the maturity. In other words, allowing these securities, $4.5 trillion or so, just to mature and rolling off. It's hard to understand how that would create vagaries, if you will, relative to monetary policy that would be hard to predict. Could you share why?
Yes, I'm sorry. I did not mean to say that it would create a problem.
Yeah.
We want to allow that process to occur in a gradual and orderly way.
Wouldn't just allowing them to mature, when they mature, they roll off? Isn't that orderly?
Yes, it is orderly, and that's why we intend to do it that way.
But you haven't started yet. You're reinvesting now. I'm just curious why It just doesn't seem to me.
I agree that it is orderly, and that is our desire, to have it be an orderly process, which is why we intend to allow those assets to run off as principal matures. So we recognize, however, that allowing that process to occur results in some tightening of financial conditions. And so before we turn that process on and start it, we want to make sure that we have adequate ability through our normal overnight interest rate moves to meet the needs of the economy, particularly if it were to weaken some, which it would be a long process if it's running off, and we want to make sure we have enough scope and the economy is strong enough that that runoff wouldn't create a problem for the economy.
I just want to close with a statement. I know when you were coming in and interviewing for this post and being affirmed, you mentioned to me that when times called for it, you would allow interest rates to rise, and you're known as being a dove, but in fact you are. I know some people have criticized the rate at which those rises have taken place, probably me included, but I do want to thank you for allowing that to happen, hoping it will continue as we return to more normal circumstances. Hopefully the balance sheet will roll off, and I hope you'll continue to criticize us if we allow deficit spending to continue more so than it already is today. Thank you so much.
Thank you, Senator, and I think allowing that process to take place, that's something that will show that the economy is doing well, and the increases have been a reflection of the strength we've seen in the economy.
Senator Mendez.
Thank you. Chairman Yellen, thank you for your leadership at the Federal Reserve. Our economy, though not perfect, has made tremendous strides since the financial crisis and ensuing Great Recession, which wiped out nearly $13 trillion in household wealth and cost 9 million Americans their jobs. And I think these last 6 years have shown us how important and positive Wall Street reform and consumer protection has been to our economy, to strong markets, and most importantly to American families and businesses. Now, I want to ask you specifically, as you know, healthcare accounts for nearly 20% of U.S. GDP, including not only the delivery of life-saving, life-enhancing health services, but also fueling innovations in patient care, in diagnostics, in preventative health, and research and development of cures to diseases. In response to the FY17 budget resolution that Congress passed last month, the former director of the Office of Management and Budget sent a letter to Congress saying that the resolution would add $9.5 trillion to the deficit. Recent studies have shown that a major market disruption would have a detrimental impact on the labor market, including a reduction in job growth by nearly 2.6 million jobs in 2019. My home state of New Jersey is estimated to be among the top of the list when it comes to potential job losses as a result of a spike in the number of uninsured. Furthermore, stripping nearly 30 million people of their health insurance would have a significant impact on the productivity of the American workforce. Are you concerned about how this major increase in debt, coupled with downturn in the labor market and decreased productivity, would have on the larger economy?
Well, we would have to look at what the impact is of shifts in health care on the economic outlook. Health care, as you mentioned, does account for a very significant share of spending, and a loss of access to health insurance could have a significant impact on spending of households for other goods and services, and beyond health care itself, have impacts on the economy. In addition, access to health care has, for some individuals, likely increased their mobility and diminished the phenomenon called job lock, where people are afraid to leave jobs because of losing health insurance, and that could have implications for the labor market as well that we would try to evaluate.
So we should tread lightly before we make major changes that create disruptions. Let me ask you this. In the years leading up to the financial crisis, many lenders and financial institutions exploited the uncoordinated enforcement of consumer protection laws and misled consumers into expensive and risky subprime mortgages, even if they qualified for prime rates. As part of the landmark Wall Street Reform and Consumer Protection Act, we were finally able to empower a cop on the beat to protect hardworking Americans from unfair, deceptive, and abusive financial practices. And from my view, it's been working. As an independent agency whose sole job is to enforce consumer protection laws, the CFPB has returned almost $12 billion in relief to more than 29 million consumers. And more importantly, the Bureau has helped level the playing field for hardworking American families, ensuring that consumers are protected when they purchase a home, open credit cards, take out student loans, and use prepaid cards. Do you believe that if an independent consumer-focused agency like the CFPB had existed to police mortgage markets prior to the financial crisis, that much of the economic damage to working-class families would have been avoided? In addition to protecting individual families, would better enforcement of consumer protections also have enhanced national financial stability?
Well, I do agree that consumer abuses in the mortgage and securitization areas played a key role in the crisis. The Federal Reserve at that time had responsibility for enforcement of these regulations, and in retrospect, I wish the Fed had acted more aggressively and earlier to address those abuses. We've certainly learned from the financial crisis that it's critical to monitor this area and the potential for deceptive practices in consumer lending to create a financial crisis or financial stability issues.
So an entity like the Consumer Financial Protection Bureau, which has in essence done that since the Great Recession, has played a critical role in ensuring that. Certainly I agree that had the Fed been more active, along with all our other regulators, about being the cop on the beat instead of being asleep at the switch, it would have been great. But in the absence of that, a bureau like the Consumer Financial Protection Bureau is actually playing a significant role in ensuring that consumers have a level playing field. Is that not a fair statement?
Well, they have been focusing certainly on these issues.
And let me close by saying in the 104-year history of the Federal Reserve, it has had 134 different presidents of regional banks. Not one of those 134 presidents has been African American or Latino. That's pretty outrageous. And it is my hope that now that there are some openings, that we begin to change that reality. These are two communities that have an enormous part of contributing to the nation's GDP. And for them not to have any representation whatsoever in the process of these banks is not acceptable. And I hope we can begin to change the reality.
Increasing diversity is a critical priority, and I share your hope.
Senator Toomey.
Thank you. Thank you, Mr. Chairman. Madam Chair, thank you very much for joining us yet again. I want to briefly ask you a question about the FOMC forecast for growth at the December meeting. As we all know, we had an election in November in which a president and a Congress were elected, and a very, very central part of the message of both the president and the Congress included a commitment to tax reform, a commitment to a very different regulatory approach, including a much lighter regulatory touch and rollback of existing regulation. And there was considerable discussion also about a fiscal stimulus in the form of an infrastructure bill. But I don't think anyone disputes that the president campaigned on tax reform, campaigned on lighter regulation, campaigned on this. It seems that most of the world responded with the view that that increases the likelihood, no certainty here, but increases the likelihood that we would have stronger economic growth. Equity markets responded powerfully and immediately. Bond markets sold off, which is consistent with the view of stronger economic growth. The IMF projected stronger economic growth. A poll of economists by the Wall Street Journal showed a very strong consensus that growth was likely to tick up. The World Bank suggested that tax reform alone would add 0.8% to American GDP in 2018. And yet, the December Fed meeting, the FOMC members had no change in their opinion at all, as far as I can gather, about the prospect for economic growth. In fact, the upper bound, the highest estimate, actually decreased. So, it just looks on the surface like the FOMC members either believe it's unlikely that any of those things will actually happen, or they think that those things are not particularly pro-growth. And obviously the rest of the world is of a different opinion. Does the Fed have the view that the prospect for growth are not at all changed by the prospect of tax reform and regulatory reform?
Well, we don't yet have clarity on what economic policy changes.
I understand there's no certainty. This is about likelihoods.
Most of my colleagues decided that they would not speculate on what economic policy changes would be put into effect and what their consequences would be. A few of my colleagues mentioned that in writing down those forecasts, they assumed that there would be a mild fiscal stimulus. But most of my colleagues have taken the view that we want greater clarity about the size, timing, and composition of changes to fiscal and other policies before trying to incorporate those into our forecasts.
Okay. That's what I suspected. Let me move on to CCAR. I sent you a letter last week outlining some of the big concerns that I have about CCAR. And let me just touch on a few of them briefly. First of all, compliance is enormously expensive for the banks who are subject to that. There's a recent GAO report that suggests that the CCAR models employed by the Fed and testing procedures are not transparent. Well, that's, I think, generally acknowledged. The GAO report goes on to suggest that the Fed does not engage in sufficient risk management of the systems of the models it uses. The GAO report also concludes that the Fed has not assessed whether CCAR is inadvertently pro-cyclical, despite the intent that it be counter-cyclical. I'm concerned that CCAR might actually increase systematic risk in one important respect by correlating the risks of bank behavior and allocation of capital. And the CCAR's implicit risk weighting, which we have to infer because they're not explicit, are very, very different from those of the banks and, for that matter, Basel III. Now, as you know, CCAR is not required by statute. CCAR, DFAST is required by statute, but CCAR is not. And you mentioned earlier that there's been a huge increase in the capitalization of American banks post-crisis, which is certainly the case. And the Fed already has other ways of boosting capital requirements like the countercyclical capital buffer and the GSIB surcharge. So my question is, given all of that, isn't CCAR at least somewhat duplicative? And since it is very, very costly and not mandated by statute, would you consider bringing it to an end at some point in the foreseeable future?
Well, I think it's a key part of our regulatory process. It is a very detailed and institution-specific and forward-looking assessment of the risks in a firm's balance sheet. And I think it's been a cornerstone of our efforts to improve supervision, especially of the largest banking institutions that whose stability is really critical to overall U.S. financial stability. The GAO, in their assessment, found that the stress tests have been useful and have played a useful role. They did not recommend that we end them. They made a number of specific recommendations, which we agree with and are working on. And we will, of course, continue to review our practices as we recently changed CCAR to exempt most of the institutions under $250 billion from the qualitative part of the CCAR review. But I do think that stress testing has greatly strengthened our process of supervision.
I appreciate that. I would just point out that in the absence of CCAR, that does not necessarily imply the end of stress testing. DFAST is a mandate for stress testing that occurs separately. Banks do their own stress testing. So I do think it's duplicative. Mr. Chairman, if I could just make one quick closing comment, and that is, as we all know, we have had a de facto acting vice chair of supervision who never went through the nomination or the confirmation process and nevertheless exercised the powers of that position. It is my hope that the President will soon be able to nominate individuals to complete the Board of Governors, including a vice chair for supervision, who will go through the process, who will be vetted and confirmed by the committee, and until such time, I hope the Fed will refrain from issuing major new regulations, which I think really ought to benefit from the input of these new people. Thank you.
Thank you. Before I go to Senator Rounds, Senator Shelby had one quick question.
I'll try to be quick. We haven't talked about this, Madam Chair, but the current account, our trade imbalance, what would you just share with us, and of course you're sharing this with the American people, the long-term danger of an imbalance in trade that we've run in for years and years, as opposed to short-term and so forth, and where are we? And you're an economics professor, but we were taught that's not a good thing in the long run.
So we have a current account deficit that is...
Tell the people what that is. Most of the people here know, but you have a nationwide audience here this morning.
It's the difference between the amount that we spend on goods and services that we import from abroad.
Import versus export, isn't it?
Correct, of goods and services. So we do have a current account deficit. It has increased in size, and ultimately it leads to a buildup of our indebtedness to foreigners. And so it can be a long-term concern if it's not on a sustainable course.
What is it roughly now?
I believe it's...
Roughly. You can furnish the exact figure for the record if you don't have it.
I believe that in 2016 it amounted to about 2.6% of GDP.
And in dollars, what would that be roughly?
It about close to $500 billion is a deficit, a little bit below that. That's
in 1 year, right?
Correct.
What's our total indebtedness?
I don't have that figure.
Would you furnish that for the record?
Yes, we've had deficits for some time. So
would that be in the trillions?
Substantially. Yes, I'd be happy to furnish you with that figure.
Would you call that a troubling thing long term?
It depends on what the long-term trend is. It also depends on what we earn on our foreign investments versus what we pay. And historically, we have earned more on our assets that we hold abroad than we've paid to foreigners who hold our assets. But the trend there is important.
When was the last time that we had a surplus, small, I'm sure, in our current account, roughly?
I'm not sure.
Will you furnish that for the record of the...
Certainly.
Has it been a number of years?
It has been.
Okay. Thank you, Mr. Chairman.
Thank you, Senator. Senator Rounds.
Thank you, Mr. Chairman. Madam Chairman, first of all, thanks for being here today. You have a difficult position, and yet a very important position, and I look forward to working with you in promoting sound economic policy in our country. As I'm sure you're probably aware, the ag sector of our economy is suffering. The Wall Street Journal recently pointed out that soon there will be fewer than 2 million farms in America for the first time since the Louisiana Purchase. We are rapidly approaching a crisis in the ag sector. Commodity prices have been sinking. The Ag Department estimated that those who are still able to farm will see their incomes drop by nearly 10% in 2017, and the strength of the dollar is making it harder for American farmers to compete abroad. Our nation's farmers are being left behind. And my question to you is, recognizing that they need access to capital, they need access to literally being able to borrow money, and during a time in which we've made it a little bit more difficult to borrow money, a lot of these folks are now seeing an end in which they because they work in an industry which is seasonal and dependent upon the weather. Some years they make it, some years they don't. Is there something that, could you just suggest to us, number one, what you see in terms of economic headwinds for our ag economy, and what we as policymakers should be focusing on if we want to help them make it through this next couple of years? Colorado right now is setting up an emergency hotline for suicides for the farming and ranching communities. This is not something that's going to go away quickly, and clearly it's gathering momentum. Could you just talk to us in terms of what you see things that we can do to perhaps take some of the burden off of these farming families?
So I can't give you recommendations for what Congress should do to address the ag issues. We are focusing on the fact that there's pressure on commodity prices and particularly on food prices after a number of years in which conditions were really very strong and land prices were pushed up. So in some cases, we are seeing increases in delinquency rates on loans. And certainly weak growth in the global economy coupled by a dollar that began to appreciate substantially around mid-2014 has pressured farmers and is putting pressure on agriculture, as you indicated.
I think more specifically, farming moves from year to year. You can have a drought. You can have excessive moisture sometimes, and not every single year you're going to be consistently successful in your endeavor. Would it be fair to say, though, that with regard to our financial institutions and their ability to either loan or to continue to carry debt, shouldn't there be some understanding within the policy at the federal level that the ability to survive not just a 12-month cycle, but perhaps a 24-month cycle or a 36-month cycle, it would seem that would be an appropriate a policy to at least continue to explore. Would you see some value in that?
Honestly, this is something that really is up to Congress to consider and to look into. It's not something that the Federal Reserve has the ability to mandate.
But financial institutions, which are the source of that ability to borrow money, and during a year in which you have a bad year for crops, or perhaps commodity prices, even in a good year with yields, may be down for a while, but in a cyclical manner, it seems rather illogical simply to base the ability to borrow money from a financial institution on a 12-month cycle, which seems to be what we do when we talk about balance sheets and so forth, from one year to the next. Should an operating loan be extended and so forth? What I'm asking, I guess, is wouldn't it make some economic sense to be able to allow this segment of the economy perhaps a different cycle to be considered in without having their loans being considered non-performing assets in the auditing of those financial institutions that really do want to continue on and carry credit forward for more than a one-year period or a short-term period of time?
It's something that we can look at, but I think financial institutions are trying to engage in safe and sound lending and want to be careful to protect themselves from losses.
Thank you, Madam Chair. Thank you, Mr. Chairman.
Thank you, Senator. Senator Cotton.
Thank you, Mr. Chair, and thank you, Madam Chair, for appearing before us once again. I'd like to discuss with you today wage growth, or maybe I should put it better, lack of wage growth. The Federal Reserve tracks wage growth as a measure of economic progress and inflation. Over the past 8 years, wage growth has been largely stagnant, although fortunately we've seen a few positive trends in the last few months. But I also want to look back beyond just the last few years, starting in the 1970s, and I think we have a graphic that will display this. Wages for workers with college degrees has increased while wages for workers without college degrees have declined. For workers with less than a college degree, wages have declined by 17%, all in inflation-adjusted terms. Could you comment on what's driving the recent wage growth, but also what's behind this phenomenon we see on the chart behind me?
Well, over long periods of time, the general average nationwide trend in wage growth depends on productivity growth. And in recent years, productivity growth has been relatively depressed in comparison, say, with a very long period from, say, 1949 to 2005. Productivity growth was probably a percentage point or so higher than it's been subsequently. For different groups in the economy, as your chart focuses on, changes in wage growth depend on structural trends in the labor market and in the economy. And what we've seen, importantly, because of technological change that has raised the return to skill, raised the demand for skilled workers, and raised the rewards to people who are able to use technology, I think coupled with globalization that has made it easier to offshore or outsource jobs that involve routine work that can be done elsewhere or is subject to technological change. We've seen different trends for much faster wage growth for higher skilled individuals and much slower wage growth for those who are less skilled. The gap between the earnings of college-educated and high school-educated or less individuals continues to grow, and this has been a major source of the trends that you are describing in your chart.
We have seen some improvement in recent months. Do you care to venture an assessment of why we're seeing that?
So the labor market is pretty tight, and wage growth has picked up somewhat. For example, average hourly earnings were up 2.5% in the 12 months ending in January, and that would compare with around 2% from 2011 to 2015. And some other measures are rising somewhat faster. There's not a dramatic increase in wage growth in recent years. There's some evidence of a pickup, but not dramatic. In part, I think you're seeing a reflection of a healthy labor market, tight labor market conditions, but the fact that it remains so low is also related to weak productivity growth in the U.S. economy.
And what's been contributing to a tighter labor market?
Well, we've had, we're trying to do our job, and we've put in place conditions intended to lower the unemployment rate, improve labor market conditions. You have seen the unemployment rate come down. The pace of job growth really is strong and exceeds what's probably sustainable in the longer run, and the labor market has continued in a general sense to improve, although clearly the gains are not evenly distributed among different segments of the population.
If the labor market were to continue to tighten through both more economic growth, but also, say, through a gradual reduction in the number of unskilled and low-skilled immigrants or guest workers that we're bringing into our country, would we see continued wage growth, in particular for those with a high school degree or less?
So I'm not certain. I mean, I expect the labor market to continue to improve somewhat further. We have to be careful not to allow conditions to become so tight that we push inflation above our 2% objective, and we will be attentive to that, but I do expect somewhat stronger labor
Is that a serious risk at the time when the workforce participation rate is still at a relatively elevated level?
So the workforce participation rate has been trending down.
But historically, it's still high.
It's relatively high, but it is over time going to be trending down, and immigration has been an important source of labor force growth. So that would be reduced if immigration were to diminish.
Thank you.
Senator Warren.
Thank you, Mr. Chairman, and it's good to see you again, Chair Yellen. So the 2008 financial crisis cost millions of people their jobs, their homes, and their savings. And in response, Congress passed the bipartisan Dodd-Frank Act, which aimed to prevent big banks from blowing up the economy again. Now, President Trump has called Dodd-Frank a, quote, disaster, and he has vowed to, quote, dismantle it. He started down that road 2 weeks ago when he issued an executive order on financial regulation, and he's put two men, Steve Mnuchin and Gary Cohn, who have spent a combined 42 years at Goldman Sachs, in charge of rewriting the rules to help big banks like Goldman. Chair Yellen, I know you and the Fed spend an enormous amount of time looking at actual data about the economy and financial markets. So I want to follow up on Senator Brown's questions and get your take on some of the administration's main reasons for calling Dodd-Frank a disaster. When he unveiled his executive order, President Trump said he hoped to, quote, cut a lot out of Dodd-Frank, close quote, because, quote, friends of mine that have nice businesses can't borrow money. Now, I'm aware of the small business survey that you cited earlier, but I want to look at the bigger range of data. What do the data show about business lending since Dodd-Frank was enacted in 2010?
Well, C&I lending, at this point, it's grown and it exceeds, after declining, it exceeds its 2008 peak on an inflation-adjusted basis. The same is true for total loans held by commercial banks. Since the end of 2010, total C&I loans outstanding have grown over 75%.
Wow.
And in the most recent period for which we have data, the recent 12-month period, C&I loans grew over 7%, and small C&I loans, which are usually sort of small business related, grew almost 4%. So we have seen healthy growth in actual lending in the economy. The survey that I mentioned to Senator Brown, I believe over half of small businesses indicated that they absolutely didn't need to lend and had no desire for credit for a variety of reasons.
I mean, didn't need to borrow.
Did not need to borrow at all, including slow growth in the economy.
Yeah. So thank you very much. Very impressive. So the data do not back the president up here. Another claim, this from President Trump's economic advisor, Gary Cohn, is that banks have been forced to hoard capital and, quote, have been forced to literally build capital and build capital instead of lending capital to their clients. Now, Chair Yellen, when regulators impose a capital requirement on a bank, does that requirement prevent the bank from lending out that capital? Or in other words, is a capital requirement a reserve requirement? Can banks do whatever they want with that capital, including lending it?
It's not a requirement that they take money and stick it in a safe where it can't be used. It's a requirement that they finance the lending that they want to do with a certain amount of capital and not only with debt. So the capital is used to make loans.
Good. So the president's chief economic advisor is wrong about that pretty basic fact. Let's look at another statement by Mr. Cohn. He said, we have the best, most highly capitalized banks in the world, and we should use that to our competitive advantage. But on the flip side, we also have the most highly regulated, overburdened banks in the world. That sounds an awful lot like a contradiction to me. Either our banks have a competitive advantage because the world knows that we carefully regulate our banks, or our banks have a competitive disadvantage because of those requirements. So, Chair Yellen, which one is it? How have our banks done in comparison to their foreign competitors since we put our new rules in place?
So I don't have all the numbers at my fingertips, but I believe that our banks are more profitable. As I mentioned, they have higher market values relative to their book values, and they are capturing market share, for example, from European banks. So I guess I see well-capitalized banks that are regarded as safe, sound, and strong as conferring a competitive advantage on those banks in competing for business.
A competitive advantage, taking away clients from other banks. In fact, our banks have thrived since we passed Dodd-Frank. Both big banks and community banks are making literally record profits. Mr. Chairman, I would like to submit for the record the most recent quarterly report from the FDIC to show that banks of all sizes are more profitable than ever, as well as this Wall Street Journal article from November entitled, U.S. Banks Report Record Profit in the Third Quarter. May I do that?
Without objection.
Thank you, Mr. Chair. Thank you. Look, on any issue, but especially on something as important as the rules in place to stop another financial crisis, we need to start with facts, real facts, not those alternative facts that the administration has become known for. And the facts show that Donald Trump is wrong and his chief economic advisor is wrong about every major reason that they've given to tear up Dodd-Frank. Commercial and consumer lending is robust. Bank profits are at record levels, and our banks are blowing away their global competitors. So, why go after banking regulations? The president and the team of Goldman Sachs bankers that he has put in charge of the economy want to scrap the rules so they can go back to the good old days when bankers could take huge risks and get huge bonuses if they got lucky, knowing that they could get taxpayer bailouts if their bets didn't pay off. We did this kind of regulation before, and it resulted in the worst financial crisis since the Great Depression. We cannot afford to go down this road again. Thank you, Chair Yellen. Thank you, Mr. Chairman.
Senator Scott.
Thank you, Mr. Chairman, and thank you, Chair Yellen, for being here this morning. I guess about a month ago, you had a teacher town hall meeting with post-secondary economic educators, and you had a question about Dodd-Frank as it relates to repealing it or changing it, and part of your answer was community banks feel the burden of regulation is very great. And I really feel strongly that we should be looking for ways to mitigate regulatory burden. And we are looking for ways, particularly for smaller institutions, to mitigate that burden. There could be modifications to Dodd-Frank that could succeed in reducing regulatory burden for smaller institutions, to quote you. I would love to hear your thoughts and your recommendations on ways to mitigate that regulatory burden for small banks, specifically small banks in places like South Carolina and other states.
So, yes, let me reiterate what I said there. It's important to look for every way we can to mitigate the regulatory burden. What we've suggested previously, and I would reiterate with respect to Dodd-Frank, is that Congress might want to consider exempting community banks from the Volcker rule and some of the incentive compensation provisions that apply to them, and those would be examples. There's quite a bit we see being able to do ourselves, and we've taken steps to extend the exam cycle for well-managed and well-capitalized banks. We're reducing the duration of our on-site loan reviews. We've heard from community bankers that when big teams of examiners come in and stay in the bank premises for a long time, it can be quite disruptive, and so we're doing much more work off-site. We're trying to reduce our documentation requests and tailor them to areas that we think are high risk that we want to examine. We do a lot to many of the regulations that we put out apply to the largest banking organizations and not to community banks. And so we try to make clear to community banks this new reg, this just doesn't even apply to you. You don't have to worry about that. We try to make clear what does apply to community banks and what portions of our regulations don't apply to community banks. We're trying to reduce the frequency of our consumer compliance exams for banks that are well managed and low risk. So those are some of the things we're doing. We are attempting through our gripper